Good afternoon, everyone. This is Henry with Simpler Trading, and in tonight's free video, I'm going to bring you a bit of a broad overview, right? Because the nature of this market has been pretty volatile. Things can change kind of on a dime. They can change very quickly intraday, as we saw through Thursday's session. I think if Friday opens well, there is the potential for a little bit more of a short covering rally, right? Which is just to say into the May expiration, which will be the 20th. Again, that's the third Friday of the month. I'm thinking there could be some type of a little bounce up into, let's call it 400 is kind of the first large psychological value. And then I'll have to think through it a little further from there, gauge the strength, and actually see if there are any pieces of leadership that are actually showing up. But what I wanted to point out is say, all right, you can bounce however far, and maybe that's the tone of the monthly expiration. But then once that bounce is over, there are three things that I'm looking for to see that we can actually make a long-lasting low in the S&Ps. And the first of them comes from the VIX. The VIX to me has been a very interesting product to evaluate over the past several sessions because you've seen sharp drops in the indexes, but inside that, the VIX hasn't become too excited, right? It's kind of been complacent here around the, 30, maybe between 30 to 33 area, all very accepted in that, despite the big drops in equities. What I think that means is that there is still a bigger drop that's waiting, right? Something that does finally force volatility products into a new 52-week high. And on that panic move, maybe a more lasting low can be made. So that's one of the metrics. Does not have to happen, but I do think it is worth keeping in the back of your mind, especially when you see how it hasn't been able to take off in the past couple of weeks. Now, in a similar way, and something that you almost saw today, but not quite, and that is that the put-call ratio needs to do the same thing, right? Today, Thursday's trade, you saw that pretty significant flush, and this ratio rallied to be just one tick shy of the high that you saw during the Ukrainian invasion. That print kind of spurred a little bit of short covering, but again, did not actually make the new high. So the second thing that I want to see before I think a more meaningful low is in for equities is that this is exceeded and that the put-call ratio actually makes some type of reading up into this area above 1.2. It doesn't have to make extensions, but it needs to make the new high, and then I'll begin considering it. The third, last thing that I'm putting out there, emphasizing that it does not have to happen, but just be careful out there, and consider the fact that we might need to see one of these kinds of days before you can get enough panic to flush everyone out that's just been trying to stubbornly hold on. Once all of that, participation is out of the market and, basically that sentiment and that extreme emotion is what may actually give us a good opportunity to buy. So any level will do. I would say that if you got a 7% decline and you hit those circuit breakers, you're starting to see enough panic, enough margin calls, etc., that the astute trader will be able to step in and find something to buy. So keep that in mind as you approach the next couple of weeks. Let me know if there's anything else that you would be adding to this list, and I look forward to talking with you guys in the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful, and if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com. And I hope to see you in the chat room sometime soon.